Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. European futures slide as Donald Trump vows to impose additional tariffs on China and 25% levies on imports from Canada and Mexico, hitting America's three biggest trade partners. Israel and Lebanon's Hezbollah are said to be close to finalising a ceasefire deal, with the Israeli Security Cabinet set to vote on the agreement later today. And the EU proposes sanctioning Chinese firms that it says are aiding Moscow's war effort. More restrictions on Russia's oil tankers are also said to be under consideration. Happy Tuesday. European futures then to the downside, and quite dramatically, maybe European equity markets and European investors asking the question, is Europe next after the Trump tariff threat aimed again at Canada, Mexico and China? European futures then down almost a full percentage point as things stand. FTSE 100 futures looking low by 34 points. You're looking at S&P futures currently flat after some softness yesterday. NASDAQ futures currently flat, I should say. US stocks ended with gains of around 0.3%. So there was some optimism by the close of the play yesterday stateside, but now being recalibrated around these additional tariff threats coming through from President-elect Donald Trump. Let's flip the board and have a look cross-asset. Then you saw, of course, that rally in Treasuries on the nomination of Bessent as Treasury Secretary. We'll see, of course, if he gets confirmed. Some of that being unwound then in the last 12 hours or so on the back of this news from President-elect Donald Trump. 426 right now on the US 2-year. Currently unchanged. The US 10-year as well in focus. Yields have come in around 4 basis points. Dropped about 14 basis points since November the 5th in the election of Donald Trump. Euro dollar currently at 104, a little softer by 0.2% on the single currency. Brent 73.26, currently up 0.3% on oil after the moves that we saw yesterday lower on those ceasefire expectations. We have OPEC Plus and that decision coming up this weekend. Bitcoin at 94,708, currently up 1%. Let's get to the details then in terms of what we've been hearing from President-elect Donald Trump, saying he will impose an additional 10% tariff on goods from China and 25% on all products from Mexico and Canada, citing a clampdown on migrants and illegal drugs. Let's bring in our chief North Asia correspondent, then Stephen Engel, with the details, of course, and the focus on what is happening, the implications for China as well. Steve, what is behind this move then? What is the rationale?
Well, Donald Trump, 2 months before he takes office for his second term on January 20th, is kind of, again, ratcheting up the rhetoric as far as the threat of tariffs. This is not in relation to that campaign threat of 60% tariffs across the board on all Chinese imports to the United States. This is in addition, based on other campaign promises to seal the border and also crack down on illicit trade across those borders, including fentanyl. And he has firmly blamed China for at least helping facilitate that with the precursors potentially coming from China and then processed in Mexico and then brought across the border. So in addition to essentially putting an additional 10% tariff on all Chinese imports to the United States, regardless of that threat of 60%. This would be on top of the already 25% tariffs that were instigated in his first term. He's basically saying China needs to respond and react to this claim that they are facilitating the fentanyl trade. It's something that China has denied. And Donald Trump says so far all his efforts and the pledges of the Chinese government are for naught. So he's going to push ahead for that. Perhaps even more interestingly is this threat of 25% tariffs on day one. On January 20th, he'll sign an executive order for 25% tariffs on Mexican exports to the United States as well as Canadian exports. Probably the Canadian one is significant because of all the oil and gas exports that Canada provides to the United States, as well as auto parts and autos themselves. The automobile supply chain between Canada and the United States are heavily intertwined. Those are the two big export products from Canada. So we're going to have to wait and see. But right now, 2 months before the inauguration, Donald Trump is stirring things up.
Yes, it certainly is, isn't it, Steve? And as you say, look, stinging criticism of these trading partners, but also the potential massive impact of these threatened tariffs. What has the response been so far?
Well, so far we have heard reaction from China. We're hearing that Liu Pengyu, he's a spokesperson at the Chinese embassy in the United States, saying again, there will be no winners in a trade war or tariff war. He says China has taken measures to combat drug trafficking and has informed the United States of the progress of its anti-drug law enforcement operations. Keep in mind, Presidents Biden and Xi came to some sort of agreement on the sidelines of APEC in San Francisco that China would do what it could to crack down on the supply of those precursors for the potential creation of fentanyl and other illicit drugs, perhaps in places like Mexico, without necessarily admitting that China is responsible. We're also hearing that Prime Minister Trudeau has had a phone call with Donald Trump explaining Canada's and the United States' long-term position as cooperative neighbors. Chrystia Freeland, as you can see on the screen here, the Deputy Prime Minister also highlighted those strengths between Canada and the United States and went on to remind in his statement that 60% of America's imported fuel needs come from Canada.
OK, Chief North Asia Correspondent Stephen Engel, thank you very much indeed on the details. Let's get the market reaction then to this story and check in on how Asian markets in particular are faring with Avril Hong joining us out of Singapore. Avril, what is the picture right now?
It is mixed, Tom. Really interesting to see. I mean, we see that knee-jerk risk-off reaction in Japan, Taiwan, South Korea. Those are the markets that are underperforming, but it's not as bad on Chinese stocks. We actually saw some of these gauges managing to clock gains earlier in the session, though note here that turnover is low, so there's not a lot of strength behind the gains. Some are attributing what we're seeing in Chinese stocks today to the idea that we're going to get fiscal stimulus and maybe also the idea that there's room for negotiations on these potential tariffs. Let's flip the board because I think the clearer read on these narrative surrounding tariffs is on the currency space. If we can take a look at this next page, it'll show you how the currencies are faring today. The Aussie got hard hit. I mean, this is an economy that's closely tied with China, of course, and we saw it losing 1+% against the greenback, pairing some of those declines now. The onshore renminbi both weakening towards the 2627 handle, 726, 727 thereabouts. The Japanese currency, really interesting to say, is among the top gainers today. And this is a bit of an old school haven play, perhaps also traders warming to the idea of a December BOJ rate hike. Let's flip the board and take a look at this chart. In the context of the yuan weakness we're seeing today, I wanted to highlight what Chinese authorities have been doing recently in terms of ramping up support for the renminbi via the yuan fix, which is, of course, the rate around which the Chinese currency is allowed to trade. And we're seeing that it's been much stronger than estimates recently. And something that our MLive colleague Mark Cranfield, I love quoting him, he's been highlighting that when you're seeing China, trying to stabilize the stock markets, the last thing that they need right now is a free fall in the Chinese currency. So keep that in mind, that support for the currency. Tom?
OK, pronounced support coming through for the Chinese yuan, reacting, of course, as well, and facing the pressure coming through from this tariff threat. Avril Hong with a deep dive on the market reaction to that story, joining us out of Singapore. Thank you. Let's get more analysis right now on the moves that we're seeing, particularly with the strength in the US dollar, with the Bloomberg dollar index up 0.3% right now. Yields up 1 basis point on the US 10-year, which is yielding you 4.28. Of course, the ripple effects across the global financial markets on the back of these tariff threats. Let's bring in Valerie Teitel for the details. Val, talk to us then about the potential impact of 25% tariffs on key trading partners for the US, Mexico and Canada.
Look, so far, Tom, in this knee-jerk market reaction, we're seeing most of the reaction in FX. We had the Mexican peso sliding 1.3% versus the U.S. dollar. The Canadian loonie also sliding nearly 1% versus the U.S. dollar. But, Tom, it's notable to see that they are well off the lows of the session. If you flip on, we can just take a look at how these currencies traded on that announcement. They have strengthened back from the lows. The Canadian dollar, the Mexican peso peso weakened 2.2% at one time during that announcement. It has now come back. So it's showing you a bit that the market is stabilizing. We're also seeing a bit of that stabilization when it comes to the equity market. Those S&P futures broadly unchanged. If you flip on, we can take a look at them. But what's really noticeable, Tom, is these Euro Stoxx 50 futures. That's sizable weakness so far in this morning session, down 0.9%. Perhaps it could be just Europe is bracing for their own Trump memo on tariffs, but it is very noticeable to see the underperformance in European futures. Maybe it's to do with their more broad links to China and that the tariffs could hurt the Chinese economy globally. But very interesting to see the underperformance is centered in Europe.
Yeah, bracing for maybe a tweet when it comes to Germany or the Eurozone from incoming President-elect Donald Trump. Talk to us about what this means. This is obviously, you pass this very closely, Val, which is the impact on the Fed, the Fed's thinking. Where does it leave the Federal Reserve?
Very interesting to ask that, Tom, because we actually heard from Fed Kashkari speaking to Bloomberg. He was talking about tariffs. And for the Federal Reserve, they're only concerned about a broader inflation impact if we get retaliatory tariffs. It's probably too soon to tell if we're going to get some sort of retaliation from China. The Fed only meets in the next 2 weeks. But it is notable to see that we have seen pricing for this Fed meeting basically subside in the market. We're now looking at a 14 basis points of a cut for that December meeting. And over the next two meetings, we are now only pricing in 20 basis points total cumulative over the next two meetings for a cut from the Federal Reserve. Kashkari also told us overnight in this interview that he very much is keeping the door open for a Federal Reserve rate cut. We have yet to hear of any strong narrative from a Fed official that they're going for a pause in the December meeting, but the market is increasingly pricing it in.
OK, Bloomberg's Valerie Teitel, thank you very much indeed on the market reaction to this story of the day, of course, coming through from President-elect Donald Trump and the market adjustments to that. Now, to one of the geopolitical stories of the moment. Bloomberg understanding that Israel and Hezbollah are inching closer to signing a ceasefire deal that may happen in the coming days, possibly as soon as today. Let's bring in Bloomberg's Paul Wallace in Dubai, who leads our MENA, of course, Middle East and North Africa economy and government coverage. Paul, how close are we then to a potential ceasefire deal in this region?
Hi, Tom. It is possible that the Israeli Security Cabinet, when it likely holds a vote sometime this afternoon local time, approves a truce with Hezbollah. It's a little bit unclear at this stage when a ceasefire would actually start if that agreement is approved by Israel's cabinet, and also if it has to go back to Hezbollah for its own approval. So there are a few steps that remain unclear at this stage, but certainly it seems as if we are very close to a deal. Of course, we've been in this situation many times before, particularly when it comes to Gaza, and in Gaza's case, no deal was reached. But this time with Lebanon and Hezbollah and Israel, it does seem a bit different. It seems as if enough people within the Israeli government and security establishment and within Lebanon and Hezbollah want this to happen to make it seem like it is very close.
OK, so we look at that potential ceasefire. What are the potential obstacles, Paul? You suggest that maybe this should be framed slightly differently from the ceasefire talks around Gaza. What, though, are the potential obstacles that have to be overcome?
Well, one of them is the thinking in Israel. Certainly there's some far-right members of Benjamin Netanyahu's coalition that don't want this to go through. One of them is Itamar Ben-Gvir, the national security minister. He thinks that Israel should instead just crush Hezbollah, continue going militarily until the group is effectively no more as a military organization. He thinks it would be a missed opportunity if they do go for a ceasefire. So that is a big obstacle. The other thing is just the messiness of the proposal that's on the table, this US-led draft. I think it was always going to be complicated and kind of riddled with contradictions, but it's difficult to see how this will be held together, a truce, if it does go ahead. I mean, effectively, Israel wants Hezbollah fighters to move away from the Israeli borders. You're talking you're talking about 30 kilometers or 20 miles away from the border, and for Hezbollah not to operate in southern Lebanon on the Israel-Lebanon border. It's difficult to see at this stage how that's going to be, enforced. There's talk of the Lebanese army, which is separate from Hezbollah, going into the region and policing the area to make sure Hezbollah doesn't operate there. But that's something that's in the past has just proved to be very ineffectual. Yep. And then if Hezbollah does break the terms, if Israel does start striking Lebanon again, does that mean the truce is over and we're back to war?
Okay, so still some important question marks to be overcome, but we look to today potentially for some more details on that. Paul Wallace, comprehensive in terms of what we've been hearing around this potential ceasefire between Israel and Hezbollah. Thank you. Now, coming up, the EU proposes sanctions on Chinese firms. That's as the G7 prepares to boost pressure over alleged support for Russia's war efforts. We're going to bring you the details on those measures next, that they're currently being weighed up. Stay with us. This is Bloomberg. Welcome back. Happy Tuesday. Welcome back to Bloomberg Daybreak Europe. Right, G7 nations are set to increase pressure on China for allegedly supporting Russia in that war against Ukraine. That's according to an early draft of the communiqué seen by Bloomberg as foreign ministers meet in Italy. Bloomberg's managing editor for European economy and government, Ben Sills, joins us with the details. Ben, what do we know? What are we expecting to hear in terms of this communiqué, the potential measures, the potential steps that the G7 are looking at taking on this front?
Yeah, so this is a pretty major escalation from the G7 in terms of their rhetoric. Last time the foreign ministers met in April, they were calling on China to ensure that companies within their borders weren't supplying military equipment to the Russians. This time the G7 are proposing to take measures themselves to stop that supply to the Russian military. Within hours of breaking the news of that communique, we had more news out of Brussels with the EU. As you say, they're proposing its own sanctions. These are the measures that we're talking about on Chinese firms that it says are supplying the Russian military.
OK, so we look to see if those get across the line, because, of course, I think it's my understanding that 27 nations have to approve this. You can correct me if I'm wrong on that. What's happening on the oil front as well? There seem to be additional measures that G7 countries are looking at when it comes to potential further restrictions on oil trading out of Russia. Is that something they're considering as well?
Yeah, they've been trying, since early on in the conflict to find ways to limit the amount of revenue that the Kremlin gets from the oil trade without going so far as to disturb the global market, boost prices for Western consumers. The latest thing that we're seeing on that is new measures from the EU, actually, who are looking to impose additional sanctions on Russian oil tankers. This is the shadow fleet that Russia has been using to supply its clients around the world. What we've seen in the past is they have targeted insurers and some of the services companies that facilitate that trade. So we'll be paying attention to exactly how those measures shape up as they come down the channel in Brussels.
Yeah. OK, Ben, thank you. And you're right. I should have specified that these are measures being considered by the EU, not the G7, when it comes to oil. So thank you for clarifying that. Ben Sills with the details on some of those potential sanctions on China as well that Europe is considering in terms of some of the linkages between Chinese companies and Russian firms supplying arms to Russia in that conflict against Ukraine. Now, the US Justice Department is dropping criminal charges against President-elect Donald Trump, including those related to the 2020 election and mishandling of national security information. Trump's re-election has shielded him from charges while in office. Coming up, we take a look at who is backing UniCredit's bids for Banco BPM and if the offer could succeed in creating Italy's largest lender. The details coming up. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now into the banking space. We're going to be watching UniCredit shares very closely at the open later today. That's after Monday's lower close following the Italian bank's almost $11 billion bid for domestic rival Banco BPM. It opens a second takeover front after UniCredit's Commerzbank approach, of course, with that transaction facing stiff opposition from the German government. Joining us for the details in what are some fascinating moves in the banking space is Bloomberg's Jenny Serene, who follows all of this very closely for us. Jenny, what do we know then about this latest bid by UniCredit for BPM, what it tells us about the appetite, what the size of the deal, the likelihood of it getting across the line?
Yeah, so, I mean, the likelihood is the hardest one to answer. That one, obviously, the Italian government has been very pro banking consolidation, and they've been looking to line up a third competitor that could take on the likes of UniCredit and Intesa there. And so they've been very, supportive of things like a tie-up between Banco BPM and Banco Montepaschi. And so it's sort of interesting to kind of see them now squirming and saying, well, we were supportive of that kind of M&A, but, maybe not so much this kind of M&A. And I think that's, just exactly what Andrea Orcel, the CEO of UniCredit, often does is, really puts a spotlight on some of the regulators and the local government officials and kind of puts them in the hot seat in a way.
Yeah, well, indeed. That's really interesting. They had a framing around the kind of tie-up that they were looking for when Orcel comes in around the side and says, hang on a second, maybe this is the kind of tie-up. So what does it mean for his potential takeover? That was dominating our discussion earlier in this year, the building out of the stake by UniCredit in Commerzbank. What are the implications for that potential deal?
Yeah, so we're still doing a lot of reporting around this. As far as what we heard yesterday, Andrea Orcel, the CEO of UniCredit, he talked a lot about the reception that they were getting in Germany, which was very negative. And so you see him here really kind of taking a step back, maybe putting a few more irons in the fire in a way. But certainly didn't say anything about completely abandoning the Commerzbank takeover or, having any different calculations or rationale for not pursuing that in favor of this. I think this is a person who is a skilled deal maker. And so if he wants to do both, I'm sure he could find a way to do both. And then obviously, he doesn't really mind if he rankles a few feathers along the way.
Yeah, and he's certainly doing that, isn't he? And no doubt going to be keeping you and the team very busy. Jenny Serene, thank you very much indeed. And the latest that's come through from Orcel as he makes his moves in the banking space, both in Italy and in Germany, of course. Coming up, Germany's industrial downturn deepens, talking of Germany, with Thyssenkrupp's steel unit planning to cut 40% of its workforce. We're going to get the details on that story. Let's check back in on European futures right now, shuddering under the pressure. Is Europe next, will be the question for some investors when it comes to these new tariff threats from incoming US President Donald Trump, with European futures currently down 0.8%. The messaging has been around Canada, Mexico and China in the last 24 hours or so, but there will be a concern that Germany and the Eurozone will be next in the hot seats. US futures, meanwhile, currently flat on the S&P E-minis. Nasdaq futures just pointing to very modest gains of under 0.1%. There's plenty more coming up. Stay with us. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. European futures slide as Donald Trump vows to impose additional tariffs on China and 25% levies on imports from Canada and Mexico, hitting America's three biggest trade partners. Israel and Lebanon's Hezbollah are said to be close to finalising a ceasefire deal, with the Israeli Security Cabinet set to vote on the agreement later today. And the EU proposes sanctioning Chinese firms that it says are aiding Moscow's war effort. More restrictions on Russia's oil tankers are also said to be under consideration. The market impact then on the latest lines coming through from Trump, the latest tariff threats. You see European futures down so far in the session, with maybe concerns that Europe will be next in terms of the target for incoming President Trump. Currently pointing lower by 0.8% after a flat session for European stocks yesterday. US stocks managed to eke out gains of 0.3% yesterday. Currently, US futures are a little lower. FTSE 100 futures currently pointed to losses of 31 points. S&P E-minis flat. They were lower. They're currently flat. Nasdaq futures currently pointing to very modest gains of about 19 points at 20,900. Let's flip the screen and have a look across our set. We've been hearing from Neil Kashkari saying the door is still open for a December cut from this Federal Reserve, pointing to a neutral rate of around 2.9%. Currently, the 10-year is at 4.28, yields up just 1 basis point as markets readjust to the tariff threats after, of course, Treasuries rallied on the back of the appointment of Bessent as Treasury Secretary late on Friday. Bloomberg Dollar Index currently up 0.3%. Its dollar strength is a key part of the story today, pressuring some of the commodity players and Asian FX as well. And gold trading at 2,622, currently down 0.1%. Brent in focus. OPEC Plus will be meeting on the weekend. $73 a barrel, currently up 0.4%. Certainly expectations of a ceasefire between Hezbollah and Israel will be consequential for the oil markets. Let's get to what's happening right now. The latest in terms of the woe rippling across Europe in terms of the job situation, certainly in the latest lines coming through from Thyssenkrupp, the steel unit, planning to reduce its workforce by about 40%. The steel unit of Thyssenkrupp, they could be looking to reduce that headcount by 40% this decade. The group's woes reflect a bleak outlook for many of Germany's biggest industrial companies. Let's bring in Bloomberg's Oliver Crook in Berlin, who charts all of this for us. Ollie, just how bad are things getting in Germany's industrial sector? We seem to come to you day in and day out for more news and more downside in terms of the prospects of the industrial base of Germany.
Yeah, absolutely, Tom. And it feels sort of bad going on air every day talking about the sort of decline of the German economy. But frankly, it's been the job for the last 2 years. And you say sort of charting that course. We've been charting that course in the sort of abstract, on the charts, on the PMI charts, on the industrial production charts, all of these sort of things. We've seen it on the charts, right? We've talked about manufacturing contraction in Germany for over 2 years. We're talking about the last positive print in July of 2022. That all remains fairly theoretical when you see it represented on charts. The reality of that is coming now the last few weeks. And we've had it just across the board, Tom. We had Thyssenkrupp, the latest. We're talking about 11,000 job cuts. That's 40% of their steel division. That follows Bosch on Friday, cutting 5,500 jobs down at their automotive unit. Ford last week, 4,000 jobs. We haven't got the final figure here at Volkswagen. That is what they're in intense negotiations on right now. But we're talking potentially well into the 5 figures there. So we're talking over the last couple of weeks and months, Tom, a minimum of basically 30,000 job cuts across this sort of industrial base across the board. I'm trying to figure out, where are we in this cycle? Is this sort of the beginning of the end? Is this the middle? I talked to Carsten Breschke yesterday, sort of head of global macro over at ING, who's been a great sort of prognosticator of what was going to happen in the German economy and has had it sort of bang on. He says that we're really in the middle of this. There is more to come. It started with the suppliers. We're getting it from the automotive companies. We've heard nothing, for example, from BMW and Mercedes. Are they going to be the next to announce some layoffs? I should also say, Tom, another piece of EFO data that I did find interesting a couple of weeks ago, it's not just these big companies. It's the small companies, the SMEs. The share of German companies that fear acutely for their economic survival, we're talking about companies that are able to survive, has increased to 7.3%, up 0.5 percentage point from just a month earlier in October. So again, a sort of very grim picture and unlikely to turn around anytime soon.
So what is all of that doing then to the US, to the German election? We can move on from the US election. The German election's happening in the early part of next year. You're going to be covering it for us. The impact on the politics of Germany.
So listen, what I would say is I wouldn't want to be the incumbent party coming into this election campaign where you're talking about 30,000 plus job cuts going into this, right? This could speak very easily for the sort of the detractors to the SPD and Olaf Scholz, saying that they basically mismanaged the economy. You can look at this at a couple of ways. There's, on the one hand, you could see this potentially helping the sort of Germany first parties, the sort of AfD, the far right and the far left, those who say you really need to put Germany's interests above everybody else and sort of ignore all the others. However, these are parties that don't really have the economic chops. They don't have the really credibility in the economic realm. Who tends to, often in the minds of the Germans, is the CDU, and you can see that they're leading there. They've maintained a very sort of comfortable lead there. But what they are sort of prescribing is this sort of classic thing, right? Tax cuts, cut bureaucracy, cut regulation, cut benefits, cut pensions. This is something that may be able to boost the economy in the short term. But Tom, what it fails to sort of address is the main issue here for the German economy, which is one of not having the sort of traditional export markets that it used to have, namely in China. That's in part due to the slow Chinese economy, in part due potentially to more rising trade barriers, and of course the possible Trump presidency. I mean, if you're sitting here in Germany, you see the headlines crossing about Mexico and Canada, you cannot feel at ease because these are the sources, these are the markets that have generated all of that wealth over the last couple of decades. The main question, though, for the Germans and for the German government is not just going to be sort of marginal changes around the edges. Is this what industries can you really be competitive against China in the United States, and how do you position your economy to really conquer those? Because even in the automotive sector, with the EVs sort of pulling ahead, that is not necessarily the future-facing industry that Germany currently has dominance over.
Okay, the near-term and longer-term questions for Germany. Bloomberg's Oliver Crook in Berlin with the latest. Thank you. Staying in Germany, former Chancellor Angela Merkel and Bavarian PM Markus Söder said they are open to reforming Germany's strict borrowing limits in a departure from the traditional stance of the conservative Christian Democrats, who are leading, as Ollie said, in polls ahead of February's election. The rules established following the global financial crisis limit net borrowing to no more than 0.35% of GDP to help keep the budget deficit in check. Shares in Tesla ended the session lower after California Governor Gavin Newsom announced that Elon Musk's company would be excluded from the EV rebates the state is considering. The decision may heighten tensions between Newsom and Musk, who have already clashed over California's politics. Tesla still accounts for more than half of all new EVs sold in the state. And Bloomberg has learned that Qualcomm's interest in buying Intel is cooling. It upends what would have likely been one of the largest tech deals of all time. The complexities associated with acquiring all of Intel, worth more than $100 billion, is believed to be the main hurdle. Now to the UK, where the most powerful business lobby has warned the government is in danger of losing the trust of corporate leaders if it fails to mitigate the impact of last month's budget. Chancellor Rachel Reeves addressed the CBI's annual summit in London, saying it was important to put the public finances on a firm footing.
I've had lots of feedback on the budget, but what I haven't heard is any credible alternatives to what I did to put our public finances on a firm footing. What I am really clear about, and I've said it already a couple of times today, that public services now need to live within the envelope that we've set. We will not be coming back to top up those budgets. We have set the envelope for public spending.
OK, the Chancellor of the UK, of course, Rachel Reeves. Let's bring in Bloomberg's UK correspondent Lizzie Burden standing by on set for us. Lizzie, what reaction did we hear then from business to what we heard from Rachel Reeves?
Well, I mean, I was at the summit last year and I remember very clearly Keir Starmer was a rock star last year, but that was in opposition. Now they've had this budget, £40 billion of tax rises, most of that lobbed at business through the employer national insurance contributions rise. And yeah, business is saying through the CBI, if you don't make up for that through rates reform or the apprenticeship levy or the employment bill, then you're not going to be the party of business anymore, which of course is important because Labour's top priority is growth. Their reputation hinges on getting that investment. But the CBI's latest survey says that half of businesses are looking to cut jobs, and all the economic data has been pretty dour recently. So the government's response will partly come today. They're going to be introducing this white paper, Get Britain Working, and the idea is to take away welfare from people who are refusing to go into education or training. And of course, it's going to be controversial within parts of the Labour Party because the message is get on your bike. But as you heard there from the Chancellor Rachel Reeves, it's all about fiscal responsibility. And they say that this is going to increase the employment rate to 80%, or at least that's the target.
OK, yeah, sounds like a policy taken from the Conservative Party, doesn't it? So the white paper that you'll be monitoring for us, that could be important later today out of the Treasury in terms of how to get Britain working. Lizzie Burden, who was, of course, covering the CBI for us, and the corporate and business reaction to what we've been hearing from the Chancellor. Thank you, our UK correspondent. We're going to be talking, by the way, exclusively to Matthew Long, the Director of Payments and Digital Assets at the FCA, or the Financial Conduct Authority. That's at 8:30 a.m. UK time on the opening trade. So tune in for that interview. Now, to Ireland, where voters in that country go to the polls on Friday with a very different dilemma to many of the elections we've seen in Europe this year. The country is flush with cash from a surge in corporate taxes from US firms, leading political parties to make big promises on what they plan to spend it in. Yeah, that all sounds very different to the UK and the rest of Europe, doesn't it? Our Dublin Bureau Chief, Jennifer Dugan, joins us for the details. Jennifer, this is part of the Bloomberg Big Take today. It's a great read, so counter to what we hear in terms of the fates of other nations. How much money does this Irish government have to spend?
Yeah, so the expected Irish budget surplus this year is in the region of 25 billion. That's been boosted by the 14 billion Apple tax, the rebate from Apple that the European Court ruled. So yeah, there's a lot of money. Most of that comes from, as you mentioned, corporation tax receipts. There's a huge number of US multinationals in particular in tech and pharma that have their headquarters based in Ireland, and a large percentage of the tax comes from those companies.
How vulnerable is, how sustainable is this revenue stream? And again, this isn't a Bloomberg Big Take, to correct, that's a BN priority. Anyway, so for our viewers, check it out, whatever, on Bloomberg.com or on the terminal. How vulnerable is this revenue? It's a pretty admirable revenue stream by comparison to many other nations out there, but it's potentially vulnerable to trade frictions from the US.
Yeah, for sure. It's very highly concentrated. So only 3 firms, we don't know which 3 firms they are, but certainly there have been a lot of guesses, but only 3 firms are responsible for 43% of the corporate tax take in Ireland. So it's highly concentrated and therefore very vulnerable. So it makes it very vulnerable to shocks within those particular companies, geopolitical shocks. The US election is obviously of concern as well, given the protectionist measures that are being discussed. So any change in either tariffs or US corporation tax could very definitely be a threat to that income stream.
OK, Jennifer, it's a fascinating story. It's the BN priority. It's the Bloomberg News priority. Check it out on the website or on the terminal. Thank you very much indeed. Bloomberg's Dublin Bureau Chief, Jennifer Dugan, on the $100 billion dilemma for Ireland as they lead up to that vote on Friday. Coming up, President-elect Donald Trump has vowed additional tariffs on China, as well as US neighbours Canada and Mexico. Roiling markets, of course, that is the focus. We'll bring you the details in terms of how the markets are reacting to that. That's coming up. This is Bloomberg.
This is what I'm trying to understand right now, is how much downward pressure are we putting on the economy and what is the path for inflation. But right now, knowing what I know today, still considering a 25 basis point cut in December, it's a reasonable debate for us to have.
Minneapolis Fed President Neil Kashkari there, keeping the door open to a potential cut from the Fed, another cut in December. Talking of which, the dollar is up today after President-elect Donald Trump says the US will impose additional tariffs on China, Mexico and Canada. My next guest believes this could be the time to start thinking about shorting the greenback, at least fading some of the gains. I'm joined by Sophie Huynh, Senior Cross-Asset Strategist at BNP Paribas Asset Management. Sophie, thanks for joining us bright and early this morning. Talk to us about your views on the dollar then. We're seeing the Bloomberg Dollar Index up around 0.3% in the session today. It's up around 3%, I believe, since Trump was re-elected November the 5th. It has seen those gains. You want to fade dollar strength at this point?
Yeah, so if you look at our framework and our model, we basically see that the dollar index is currently around like 4.2% expensive versus monetary policy news. If you compare where we were back in 2016, we're approximately at the same level. And then our other signal on the momentum side is also showing some signs of like max bullishness. So I think at this point, rather than adding longs, we would rather fade this move on the dollar.
Okay, so you'd fade the move on dollar. In terms of some of the hedging currencies out there as well, whether it's the Swissy or the yen, how are you thinking about positioning into those currencies as potential hedges in what many expect to be a more volatile environment?
So exactly. So the more volatile environment, there's a wider range for the outcomes for the Fed, for rates, as well as for equities. So we think that this hyper focus on the positive outcomes of this Trump scenario should start fading in the coming weeks if we start to have like a more hawkish Trump scenario. So we think that having portfolio protection at this point makes sense. And we think that yen at this point, with the Bank of Japan clearly putting a ceiling on how dollar yen could go, is definitely a good candidate. So cheap hedge. We think that the Swiss franc as well is very attractive as a short leg for any kind of bet you want to take on the FX side. They started to talk about negative interest rate policy. They're going to leverage a weak currency to start and keep easing their monetary policy.
Okay, so short the Swissy, lean into the Japanese yen. Sophie, we saw that pronounced market reaction on the back of the nomination of Bessent as Treasury Secretary under incoming President Trump, with yields lower on that news. Did markets overreact and overinterpret that nomination?
I think it's still to remain seen. We still don't know what they're really going to do in terms of policy. We're going to have more clarity January onwards. I think what's going to matter for us is there's been this focus on the reacceleration as well as potential supply demand side. And if you start to play this side of scenario, then the 10-year Treasury in terms of like range would be closer to 5.5, 6%. If we start to talk about a hard landing, the 10-year Treasury would be closer to 3.5. So I think at this point, rather than nomination, I think in terms of like the actual policy, as well as the macroeconomic backdrop and how resilient the U.S. economy is going to be, is more going to be important to determine like which level of 10-year Treasury we're going to have in the next 12 months. But as you can see, the range is very wide at this point.
Yeah, it's a wide range, as you say, between 5.5% on the US 10-year down to, what, a little over 3%. I mean, today has been a reminder, hasn't it, of the trade volatility that we need to brace for with the threat of additional tariffs on Canada, Mexico and China, which leads me to the question as to how much of this is kind of currently priced into the markets, or how difficult is it to price this kind of volatility, these kind of lines from Trump into these markets at this point?
I think the focus should be, if you look at what's been priced in terms of since the election to here, there's been much more pricing of the positive outcomes of a Trump scenario. If you look at the top three priorities, which are tariffs, immigration, as well as fiscal policies, the first two is growth negative. It's not going to be adding to the fall in terms of better growth outlook, and that's what the market is not pricing. So if you look at the rally on small caps at this point, it's more pricing the positive outcome rather than like a bit more of the negative outcome. So I would be a bit more worried about that.
What are the implications for European equities? There seems to be a mood in the session today, European equity investors starting to consider the prospect that Europe will be in the crosshairs once again. How do you play European stocks at this point?
It's been very frustrating, as in like the bearishness of Europe versus US is so extreme at this point. So if you look at all the outlooks for 2025 or even internally, people have been piling on this long US versus Europe across asset classes. So FX, equities, really all asset classes. I think at this point, you need to think about how much pessimism is already priced. Is there going to be a wake-up call? But I think in terms of the tariffs we could see in Q1 next year and implementation in Q2, what if we have a front loading of orders ahead of tariffs? And usually that's positive for the goods-oriented indices, and European equities could potentially benefit at a time where the earnings expectations are quite low versus US peers.
That's really interesting in terms of that potential sequencing of the implementation of tariffs and front loading for European corporates. Thank you very much indeed for that cross-asset check with a view, of course, and a lens on the FX space. Short the Swiss go long the Japanese yen. Some of the calls there coming through from Sophie Huynh, Senior Cross-Asset Strategist at BNP Paribas Assets Management. Thank you. There's a lot more coming up. Stay with us. This is Bloomberg.
At the Fed, at the end of the day, no matter who is in these various positions, we know what our job is. We have to get inflation all the way back down to our 2% target, and we have to try to keep the labor market strong. And we're committed to doing that, regardless of who's in the executive branch or who's at Treasury.
OK, Minneapolis Fed President Neel Kashkari speaking to us exclusively in terms of his thinking around December, keeping the door open to that potential additional cut coming through from the Fed. The market's pretty split on that. The last time I checked, there was about a 60% chance. Market's pricing in about a 60% chance of a cut in December, though that debate, of course, has ebbed and flowed in recent days and weeks. Neel Kashkari also saying that he sees the neutral rate probably around that 2.9% that's been flagged by the Fed, by the FOMC. Here's how the markets have adjusted, though, in terms of fading out some of those additional cuts expected that had previously been expected from the Fed. You now see fewer than two, just at the net, fewer than 50 basis points, I should say, by June of 2025. You don't get below 4% until about September of next year. That's how the markets are pricing at this point. Just fewer than 20 basis points priced in over the next two meetings for the Federal Reserve. Let's flip on and have a look at how the markets are reacting then to the latest headlines around these additional tariff threats coming from incoming President Donald Trump. You have seen that impact primarily, of course, on the currencies of three nations in focus, Mexico, Canada and China. And you see some readjustments and fading out some of the heavier losses, but that is a key story for us today. The opening trade is up next. This is Bloomberg.